How much can you actually spend in retirement without running out of money? It's such an important question because your retirement isn't just about how much you've saved. It's about how long that money lasts. It's often one of the most common questions we get because people know they have saved a bunch of money. They just don't know quite how to take that money out without running out. So you've worked hard your whole life. You've saved, you've invested, you've sacrificed. Now you want the freedom to enjoy the next chapter without constantly worrying if your portfolio is going to tap out before you do. In this video, we're going to break down exactly how to think about safely spending in retirement. We'll look at several different strategies for generating income, from annuities and dividends to bonds, real estate, and even market-reliant withdrawal strategies. And by the end, you'll have a clear picture of how much you can safely spend each year, how much you might need saved, and which combination of income sources could work best for you. So let's dive in. First, let's start with the foundation, what safe spending really means. And when we talk about safe spending, we're talking about how much you can withdraw from your portfolio each year, adjusted for inflation without running out of money. The classic rule of thumb you've probably heard of is the 4% rule. And we've talked about that before, but that rule says if you withdraw 4% of your retirement savings each year, your money should last about 30 years. So if you retire with $1 million, you'd start by withdrawing about $40,000 that first year, then increase that amount little by little each year for inflation. It's simple, but there are some problems with it. The 4% rule is based on data from the 1990s when bond yields were much higher and markets look different. Today, we have lower interest rates, higher inflation, and longer life expectancies. That means we need to take a more personalized approach. And there's no one size fits all. Instead, we look at your income sources, your risk tolerance, your goals, and your spending flexibility. Because the best retirement income plan isn't about finding a single percentage. It's about building a system that can adapt as markets and your life changes. So let's go through the main strategies retirees use to create income. The first strategy we'll look at is the annuity approach. Annuities are probably one of the most misunderstood financial tools out there. At their core, annuities are designed to give you guaranteed income. You give an insurance company a lump sum of money, and in return, they promise to pay you a regular paycheck for a set period or for the rest of your life. In other words, you're creating your own personal pension. There are a few different types. You have immediate annuities, which start paying you right away. You have deferred income annuities, which start at a later date. And maybe at age 70 or 75, you can have those deferred annuities start paying you. And then there are fixed index annuities with what are called income riders, which allow your income to grow based on market performance while still protecting you from losses and guarantee that lifetime payout. Now, there are a lot of different variations of all these different annuities, but just to give you one example, let's say you invested $500,000 in an income annuity at age 65. Depending on your health, gender, and interest rates, that might pay you somewhere between $30,000 and $40,000 per year for your rest of your life. That's guaranteed income no matter what happens in the market. The biggest advantage here is certainty. You know exactly how much is coming in every month, which means you can safely spend more without the fear of depleting your assets. In fact, studies have shown that retirees with more guaranteed income sources, like Social Security, pensions, or annuities, tend to be happier and more confident. Now, of course, annuities have their trade-offs. Once you put your money into an income annuity, it's typically illiquid, meaning it's locked up. You can't access it at all. It's a done deal. That's why I usually recommend using annuities to cover your essential expenses, things like housing, insurance, food, and healthcare. Now, I'm not trying to promote annuities here by any means. We're just trying to talk about one strategy before we go to the others. If your monthly expenses are, let's say, $6,000, and Social Security covers $3,000, you might use an annuity to cover that extra amount that you're missing. Maybe cover another $2,000. That way, almost all your essential costs are guaranteed, and your portfolio only needs to fill that $1,000 gap. That approach allows you to safely increase your spending rate, sometimes closer to 5% or even more, because your core expenses are already covered for life. Now, here's one downside that we see with the annuity is that annuities typically don't grow, especially if you're doing an immediate annuity. But let's say you're using an index annuity with an income rider. In general, in our experience, you're still depleting the principal. So if you want to leave money to your loved ones or an inheritance, this may not be the best strategy, but it will give you that guaranteed income. The next strategy is the dividends and interest approach. That is what many people think of as living off the income or living off the portfolio. You typically don't want to draw down the principal. You just want to live off of what you've built. So you've been building a portfolio designed to generate this consistent cash flow through dividends, bond interest, and distributions. So you don't have to touch the principal. That's the main idea. That could include high-quality dividend-paying stocks, investment-grade bonds, preferred shares, or even real estate investment trusts. So let's say your portfolio yields 4%. On a $1 million portfolio, that's $40,000 a year in income without selling any shares. Now, in reality, dividend yields fluctuate, interest rates change, and inflation can erode purchasing power. So while it feels comforting to say, I'll just live off the dividends, it's important to understand the risks. Companies can cut dividends, bond prices can fall, and sometimes to chase higher yields, investors take on too much risk, loading up on junk bonds or high-yield stocks that may not be sustainable long-term. But the appeal of the approach is clear. You're living off the fruit, not chopping down the tree. You maintain flexibility and control, so you're not locking up your money, and your principal still has room to grow. So let's look at an example. Say you have $1.5 million and your portfolio earns 3.5% in dividend and interest. That's $52,500 in income. Add in $40,000 from Social Security for a couple, and you're at over $90,000 a year in total income without selling anything. That's a strong foundation for a comfortable retirement. Many retirees use this approach because they also want to have a good income source, but also leave that money behind. They want to have that principal that's left. You can also use what we call the bucket strategy that goes along with this. So you keep 1 to 3 years of cash and short-term bonds in a safe bucket for spending. You keep your dividend and interest-producing investments in a midterm bucket, and your long-term bucket holds the growth-oriented stocks for inflation protection. That way, you can ride out market downturns without selling investments at a loss. It's simple. It's an elegant way to generate income and manage risk over time. So this is typically what we would say most people would want, is they want to be able to spend their money without drawing down their principal. And in fact, psychologically, this is a lot easier way for you to actually spend your money because you don't see your portfolio going down from you spending the money from just the dividends and the interest. Now, let's talk about the market-reliant strategy. You have a diversified portfolio of stocks, bonds, and cash, and you withdraw a percentage each year for income. This is where the 4% rule typically applies. Though in practice, we often use a more flexible range like 3.5% to 5.5%, depending on performance. So let's say you start retirement with $1 million and withdraw $40,000 per year. If the market performs well, your portfolio might grow and allow for even higher withdrawal rates. If the market struggles early on in retirement, though, you might temporarily scale back spending until it recovers. This doesn't work really well emotionally, let me tell you, because as soon as the market goes down, people typically will start getting out because what they do is they say, well, geez, I went from having 25 years in retirement to now I only have 15 years left of income or money for retirement. They get out, even though they're supposed to stay in there, and that's just because of the emotions. So this is one approach that does give maybe the most flexibility and long-term growth potential, but also gives you maybe the best chance of leaving a legacy because you maintain full control of your investments. The downside, of course, is the volatility. Your income isn't guaranteed, and if you hit a bad market early in retirement, what we call sequence of returns risk, it can dramatically shorten your portfolio longevity. That's why it's critical to have those guardrails. We often use a system that adjusts with your withdrawals up or down within a safe range depending on market performance. This ensures your plan adapts rather than breaking under pressure. The key with this approach is flexibility and discipline, being willing to take small spending adjustments in tough years so your portfolio can recover. Now, ideally, from experience, it's hard to keep people disciplined in this approach because you have emotion involved and no one really likes to spend less money. Another strategy is a bond ladder approach. This one's all about predictability. A bond ladder is when you buy a series of bonds or CDs that mature at regular intervals, maybe every year or every 2 years. When the bond matures, you use that principal to either live on or reinvest into a new bond at the end of the ladder. The advantage here is stability. You know exactly when each bond will mature and how much income it will generate. It can help reduce market risk and provide a steady income stream, especially for the first decade of retirement. The trade-off is that bond yields may not always keep up with inflation, and reinvestment rates can change over time. But as a part of a diversified income plan, a bond ladder can provide valuable short-term cash flow while letting the rest of your portfolio grow. Now, there's another increasingly popular strategy for generating retirement income, which is real estate. Rental properties can offer steady monthly income, potential appreciation, and strong tax benefits. For some retirees, owning 2 or 3 rental properties can generate enough cash flow to cover their living expenses, often with inflation protection built in since rent tends to rise over time. Let's say you own a property worth $400,000 and it rents for $2,000 per month. After taxes, insurance, and maintenance, maybe you net $1,500 monthly. That's $18,000 per year. Multiply that across 2 or 3 properties, and you could easily replace a large portion of your income. Now, rental real estate isn't always passive. It takes management, maintenance, and risk tolerance for vacancies or unexpected costs. But for those comfortable with it, or those who use property managers, it can be an excellent way to diversify income beyond the market. Another strategy that's gained traction is using alternative investments for income. This might include things like private credit funds, business development companies, or structured notes. These types of investments can provide higher yields, sometimes 6 to 9%, and may not move in lockstep with the market. But they come with added complexity and varying levels of risk. For retirees with a solid foundation already in place, meaning their essential income is covered, allocating a small portion to alternatives can be a smart way to enhance income while maintaining diversification. The key is due diligence and understanding exactly what you own. Now, I will stress that if you are going to do any type of structured notes or any type of private equity or private real estate investment trust or something along the lines of that, or private alternative investment, you really have to look into those things because there is a lot of fine print and a lot of gotchas. Another crucial and often overlooked piece of retirement income puzzle is tax efficiency. It's not just about how much you withdraw, it's about where you withdraw it from and how much you keep. Think of your retirement savings like 3 different buckets. You've got your taxable accounts, things like brokerage accounts. You've got your tax deferred accounts like your IRAs and 401ks, and you've got your tax-free accounts like Roth IRAs. The order in which you pull the money from these accounts can make a massive difference in how long your money lasts. For example, in the early years of retirement, it can often make sense to draw from your taxable accounts first, allowing your tax-deferred accounts to continue to grow. Later on, you might switch to tax-deferred withdrawals to balance out your tax bracket. And finally, if you're in your later years, Roth withdrawals can provide completely tax-free income. So coordinating these withdrawals can reduce your tax bill, minimize your Medicare surcharges, and make your portfolio last longer. This is what we call tax sequencing. It's one of the biggest levers in creating efficient, sustainable retirement income. So let's come back to the big question. How much do you actually need saved? The short answer is it depends on how much you want to spend. If you plan to rely primarily on the market withdrawal strategy, a good rule of thumb is to multiply your desired annual spending by 25. That's based on the traditional 4% rule. If you want to spend $100,000 per year and expect $40,000 from Social Security, you need $60,000 from your portfolio. Multiply that by 25, and you're looking at about $1.5 million. If you plan to use annuities or guaranteed income sources to cover part of your expenses, you might only need about 20 times your annual spending. And if you are looking at more of a conservative way or want to leave a strong legacy, you might target 30 times your annual spending for extra peace of mind. The point is, there's no single magic number. It all comes down to your income mix, your lifestyle, and your comfort level with risk. And that brings us to what I call the hybrid approach. Because in reality, the best retirement income plans usually combine several of these strategies. Maybe your Social Security annuity covers your fixed expenses, your dividend and bond income covers your lifestyle spending, and your market portfolio provides long-term growth and flexibility. It's a balanced approach that gives you more predictability, adaptability, and growth all working together. You're not putting all your eggs in one basket. You're diversifying your income sources, not just your investments. And that's what allows you to spend confidently through recessions, market volatility, and inflation without losing sleep at night. So, how much can you safely spend in retirement? The truth is, it's not about a single percentage or formula. It's about building a plan that creates reliable, tax-efficient income from multiple sources so you can enjoy your life without financial stress. If you want certainty, annuities can give you guaranteed income. If you want control, dividend and interest strategies can help you manage the cash flow. If you want growth, the market and real estate can help you with your wealth keep pace with the inflation. And when you blend these all together, strategically, you build a retirement plan that's sustainable, flexible, and built to last as long as you do. At the end of the day, retirement shouldn't be about limits. It should be about confidence. Confidence that your money will be there when you need it. Confidence that your lifestyle is protected no matter what the markets do. And confidence that you can focus on what matters most. Spending time with family, traveling, giving back, and enjoying the life you've worked so hard for. So, if you're wondering how much you can safely spend, or if your current income plan is built to last, let's talk. We'll walk through your situation, your goals, and your numbers, and build a retirement income strategy designed specifically for you with tax efficiency in mind. Because your retirement should be about living, not worrying. If you'd like to set some time up, make sure to click the link below in the description. And if you like this video, please make sure to like and subscribe and share it with your friends. I'm Oldre. We'll see you next time.